Good morning, everybody. For this quarterly market comment, I figured I'd try something new and present it in a video format. Just kind of walk through the document and provide some additional information about what we're looking at. So, without further ado, let's begin. So I always bring forward the summarized main points from the previous market comment, which is what we're looking at now. I'll just skim through that quickly here. But at present, we are in the bear market. The bears come out of hibernation. Now, what is a bear market? So the technical definition is when, call it the markets, the S&P 500, the TSX, hits a high point and pulls back 20% or more from that peak. Okay, so an asset, a security, a stock, whatever it may be, hits a high, pulls back 20% or more. This is what's known as technically as a bear market. So that's where we find ourselves today. And how does that apply to the market? So, and a lot of these slides, a few of these slides are from the previous market comment, but I figured, they certainly bears repeating, no pun intended. So if we're looking at the past 11 bear markets, when we're forecasting kind of where we think we're headed, no one knows for sure. So all we can do is base it on historical events and what has happened, what's transpired in the past. There's a saying that someone much smarter than me once coined, in that history doesn't repeat, but it does rhyme. So, this event may not play out exactly how it has in the past, but I'm almost certain there will be some similarities to notice. So let's just work with the averages here. The average overall bear market length is about 16 months. Okay, so this is the period of time where prices are declining, which is what we're going through right now. We're right in that period of time right now. So looking out though, the length to recover from that bear trough, so that's when it basically bottoms out, hits the bottom, is about 24 months, so 2 years. So all in all, about 40 months. Okay, this particular bear market technically started in January of 2022, so we're about 10 to 11 months into it. So you could figure there's about 2.5 years, give or take, before the markets get back to their previous levels. Okay, so that's kind of the time frames we're working on here. This is an interesting chart that I found. This is measuring the Dow Jones, S&P 500, and the NASDAQ, the three U.S. indices, major indices. And during a bear market, which month did they bottom? So when did they finally find the floor? When were sellers finally exhausted? And as it turns out, historically speaking, October has been the month where the most amount of bottoms have been put in. So this October, about 3 weeks ago, when the inflation print came out, the inflation reading that was a little higher than expected, this is in the States, the markets sold off. Okay, and then by mid-afternoon they had actually rallied, and so there was this huge intraday swing. Some are pointing to that and saying, that was kind of the last of the selling, that was capitulation. People just threw the towel in and said enough, and then buyers stepped in and bought up that dip, so to speak. Now, October may not mark the bottom. This is only confirmed in hindsight, of course. Maybe the bottom is going to be in March, April of next year. We don't know, but I found this interesting that there is some seasonality or past history component that would indicate that October could be the month that we bottom. Another factor, kind of speaking to seasonality, is the midterms effect. Okay, so historically speaking, once the U.S. midterms have concluded, equity markets have rallied, generally speaking, regardless of the outcome. And this chart here, we can see this line here is all the years of the S&P 500 since 1950. Okay, and then the yellow line is specifically the midterm years. So it's almost incredible how, in lockstep this works. This is right around the end of October where we see this bump up here into year end. And I mean, it kind of makes sense because September and October are generally the weakest months for the market, historically speaking, and November, December are some of the stronger months for the markets, historically speaking. So you pair that seasonality tailwind with the midterm tailwind, we might get some kind of end of year rally. That doesn't mean everything's back to normal, everything's all good, but these are kind of the factors that play into it. There's also geopolitical events happening, as we all know. Russia's invasion of Ukraine continues. China is still implementing its zero COVID policy, which simply means they're locking down entire provinces and cities. It's kind of hard to fathom. Literally tens of millions of people have been locked in their homes and condos, apartments for weeks and months on end. And it doesn't look like there's going to be any budging there from their government. So you can only imagine the psychological and emotional impact that's having on society. And they're trying to control an airborne virus, and as we've seen through the last 2.5 years of kind of on and off lockdowns, it really it's really difficult to stop an airborne virus. So that is also happening. And as China shuts down cities and provinces, out of the top 10 largest container ports in the world, China has the majority of them. Okay, so if they're shutting down ports, you can imagine what that's going to do to the global trade as well as inflationary pressures. So that is also a factor. So inflation, interest rates, and the Federal Reserve. So aside from, not to take away from those two other issues, but we feel inflation is kind of the elephant in the room here. Okay, if we think back to the late 1970s and 1980s, there was very high inflation, persistently high inflation, and some of you had mortgages that were 18-20%. Okay, inflation hit a high of 14.8% in March of 1980. The central bankers, and specifically a policymaker named Paul Volcker, raised interest rates to 11.2% towards the end of the 1970s. Okay, then in June of 1981, they raised the Fed funds rate to 20%, which is unheard of. Okay, the central bank's mandate is to control inflation and keep it between 2 and 3%. And the way they do this, the only lever they have to pull is interest rates, is raising interest rates. So in this period of time, they were successful in killing inflation by raising interest rates as much as they did, but at the same time, they tanked the economy. They collapsed the economy. There were tens of millions of people out of work, and as you can imagine, this elicited some of the strongest political attacks and most widespread protests in the history of the Federal Reserve because of the collapsing economy. And I guess the only silver lining is that they did kill inflation, but at what cost? And so this is just to highlight how dangerous persistently high inflation or sticky inflation can be. The central banks are raising interest rates very quickly right now, so let's take a look at what they have done. So here we see past tightening cycles. So these are periods of time where the banks were raising interest rates. Okay, that's what a tightening cycle is. So let's just take 2015 as an example. So you see here, it's usually 25 basis points, so 1/4%. They would raise and then they would pause. They would raise and then they would pause. They would raise and then pause. And the reason they're pausing is because there's a lag effect to each interest rate hike. Generally speaking, they take 9 to 12 months to work their way through the actual economy to reach the street. If we look at this cycle in blue here, you can obviously see that there's hardly any pause. They've just completely gone straight up, raising interest rates 300 basis points. And there'll be another one in November as well. And Canada just hiked to 3.5%. So this kind of tightening cycle is obviously extremely rare. You could argue this is unprecedented. We've never seen something like this. And here it is, just a table form. So it's easy to forget that the Fed was actually holding federal fund rates at around zero as recently as March of 2022. So in this year, the central bank's rates were at like zero, right? And the banks were buying billions of dollars of bonds to continue to stimulate the economy while seeing, inflationary pressures readings that were coming in at 40-year highs. So there's this major disconnect from what the central banks were seeing and telling everybody versus what was actually happening on the street. And they finally came to their senses in March of 2022 by raising 1/4%, and then May 50%, 50 basis points, so 0.5%, and then a completely, shotgun approach here with a 75 basis point hike, which had never been done before, followed by another one, followed by another one. So to my earlier comment that there's a lag effect, you could argue that this first rate hasn't even really filtered or funneled through the economy. So, generally speaking, when rates are rising this fast, this quickly, and exponentially, there's going to be a recession. It's almost inevitable. Whether or not it'll be a shallow recession or a deep recession remains to be seen. And each recession is different, though. It affects different industries completely differently. You think back to the pandemic, service and tourism, hospitality, the food industry just got clobbered, right? However, construction, online retail, big box stores, they proliferated, right? So each recession affects different industries differently. And okay, so now what are the results of the banks raising rates as aggressively as they have? Well, if we look here, this is just a hypothetical 60-40 portfolio, which, this has kind of been, the traditional portfolio since going back forever. And it's 60% is in equities, 40% is in bonds. And usually when one is decreasing in value, the other one will kind of balance that out. And then over time, they both appreciate. Well, this year, the complete opposite is true. That hypothetical portfolio is down almost 20% year to date. Okay, and this is the first time since the 1970s where both the equity and the bond market are both down more than 10% on the year. So this is the backdrop that we're dealing with. And this is just a table of past years where we've had a terrible outcome for a 60-40 portfolio. And I mean, we have to look back to the 1930s to find something similar to what we're seeing today. Like it is truly, obviously we haven't seen this in quite some time. What are some of the experts saying about the Federal Reserve? Well, Al Irian, he used to work for PIMCO. He's an economist. He's well known. He says the Fed has made a policy mistake of historical proportions. Jeremy Siegel, he's from the University of Wharton. He says Jerome Powell is the chairman of the Federal Reserve in the United States. He owes the American people an apology for poor Fed policy. So the Federal Reserve is certainly getting a lot of criticism, and you could argue it's justified. So how we prepared for this? We started selling a lot of tech and growth related holdings back in the first and second quarter of 2021. Our view was that interest rates would begin to rise, and we put out notes and literature to our clients saying, if it's mortgage related, look to lock in now because we do feel that interest rates will be rising. I mean, we did not anticipate, and not many people did, that they would be rising as quickly as they have in such a short amount of time. But in any case, we eliminated a lot of the tech exposure and moved that allocation to our alternative investment sleeve. And in most client portfolios, in our model portfolios, the alternative component is commercial mortgages, to put it simply. This has been one of the few bright spots year to date. That fund is up about 5% on the year and is tracking for about 7.5% to finish up the year. So we feel really good about that. It adds a layer of diversification, and this particular fund is not correlated to the bond or equity markets, so it kind of just does its own thing on the side. We also increased and added some higher dividend paying securities to bump up the cash flow and the yield in the portfolio. So overall, our model portfolios are generating projected income, so it can change, but this is the projected income of dividends, interest, distributions in the 5% to 6.5% range on an annualized basis. So, even though asset prices are coming down, we figured, look, we want to get paid for just being in the market. Let's generate some kind of cash flow just to help stabilize the downside. So that's what we've done. Here's just a kind of a humorous take on what we're going through. We're going to experience some turbulence, and this guy's a financial reporter, and of course it's all hyperbolic rhetoric, doom and gloom. These are the kinds of things that get the most clicks. Unfortunately, in society, it's always the negative headlines, but as you can see, it's usually a little over the top. But with that said, we do anticipate a bumpy ride going forward for the next 6 months or so, maybe longer, maybe shorter. The bond futures market, so the bond market is about $119 trillion on the globe, which is about 2.5 times the size of the stock market. The future market, this is the smart money, they're pricing in that the central banks will stop their tightening cycle, stop raising interest rates around March, April of next year. Okay. Generally speaking, the equity markets will kind of sniff that out. They'll sense that as they're forward looking. So we might get a rally as the central banks start changing their language, maybe becoming more softer in their tone and in their stance. That remains to be seen, though. The VIX, the volatility index, without getting into the components of that, basically on any day, if you look at the VIX and you take the number that it's currently reading, divide that by 60, and that kind of gives you the implied movements dated on a daily basis of of the indices of the stock market. So the S&P 500, the TSX, the Dow Jones. So this is simply implying where we were today when I wrote this report. It's implying daily swings of 1.8%, give or take, to the upside and downside. So for the S&P 500 to move that much on a daily basis is, to state the obvious, it's highly volatile. So big swings day in, day out, and that's what we're dealing with and have been dealing with for the last 12 to 18 months. So something to consider, the stock market gives us second to second, minute to minute, day by day updates on current price. So imagine the same are true for your home, right? You're checking on your phone in the morning, wow, it's up 5%. In the afternoon, oh, I'm down 15%. Right? This could have the same psychological effect as watching the stock market, right? If you knew what your home was fluctuating on an hourly, daily basis, which they are, we just don't see it. If you knew you were down 20, 30, 50%, would you sell? I mean, probably not, unless you absolutely had to sell if you were in some unique situation. You would probably just hold on to the assets, say, look, I know this will be temporary. It's not going to be fun. It's going to be difficult for the foreseeable future, but we will get through this. To take it a step further, what if you owned an investment property, okay, and you have a tenant paying you monthly rent? So say that property goes down by 20, 30%. Okay, you're going to sell that? Well, probably not. You're going to say, okay, I have a tenant paying me monthly rent, so yes, the value of the house will come down. However, I have this tenant paying me on a monthly basis, and we kind of liken that to the portfolios that are generating the yield that's coming into the portfolio. So again, the value of the home or the value of the assets in the portfolios will come down, yes, but we are getting paid to wait, so to speak. And eventually this tightening cycle will end. Things will normalize. So maybe being patient, might be the prudent course of action here. And just another applicable analogy to the current market activity is a shopping experience. So say, for instance, you walk into a retail store and everything's marked down, like everything's on clearance. Okay, so would you leave the store and not buy anything? Well, chances are you're gonna buy something. You say, oh wow, that's trading at that's half off. Like obviously I know that's worth more than that. I'm gonna buy that. Well, it's interesting because the psychological effects of investors and kind of the behavior finance. When asset prices come down, investors almost are inclined to sell, right? To lock in losses, to sell when it's down. And when it should be the opposite. You want to be buying when things are on discount. It may not feel right in the moment. It may not feel, you might buy today and 3-6 months later you're down even more. But you have to kind of open up, lengthen the time horizon out 1, 2, 3, 5 years and say, yeah, okay, buying something on discount was a smart move looking back in hindsight. So that's kind of how we think about this as well. This is a table just touching on recessions, and really the takeaway here is oftentimes the market will do a lot of the work ahead of the recession, meaning it's going to price in, it's going to reprice the assets based on what it thinks the recessional pressures and the outcome of the recession will be. So like I said before, the stock market is a leading indicator, so often it will price in that ahead of time. During the recession, you can usually expect some further decline, but the silver lining, that the main takeaway here is that looking at 1, 2, 5, 10 years down the road, generally speaking, there's greener pastures, right? Like buying when prices are down, generally speaking, looking out a certain amount of time, you will be rewarded for that. So that's the takeaway there. In conclusion, it's going to be okay. Keep saving, keep investing, keep your cost of living in check. Make sure your budget is in check. Make sure you're reviewing that. Making changes where needed. Avoid leverage. Don't borrow to invest, since anything with a floating rate, now any debt that's attached to a floating rate is increasing in cost to service that debt as interest rates go up, and for the foreseeable future interest rates will continue to go up. So avoid that. Avoid checking your portfolio every day. That's our job. That can have an emotional and psychological toll, and kind of let us bear that burden and wear that stress. And remember that all bear markets have one thing in common: they end, right? And this one will not be an exception. And further to that, when we kind of feel that we see a light at the end of the tunnel, the data is getting a bit better, what have you, we will most likely reach out to clients and say, look, if you saved up any money over the last few years, if you have some money sitting in cash in a bank account, maybe consider putting that into your investment account here, because this is the time that we want to be deploying cash and buying assets that are trading at a discount. So that's something we will be doing with clients, and that we'll be reaching out. So in summary, the bond futures market is currently pricing in that the banks will stop their tightening cycle around March, April of 2023. Though asset prices have pulled back, this is presenting opportunities to purchase quality companies and industries at a discount. Following the historical averages, we're more than halfway through the decline period of a bear market, so that's good news. October has been the month that has seen the highest number of bear market bottoms since World War II. Maybe this 2 weeks ago, maybe that marked the bottom. We will see in hindsight. At some point, the headline news and data will become more positive. I would say that in the next 3 to 6 months, it's probably going to get worse. But the way the markets work is they'll actually most likely be rallying or bottoming through the terrible news headlines that we'll be seeing. So that's something to look for as well. We have built up the cash and our cash allocation position in our models as a temporary defensive measure. We increased the alternative investment exposure while decreasing equity exposure. Majority of our model portfolios are projected to generate between 5.5%, 6.5% in dividends, interest, and distributions on an annualized basis. Our portfolios remain diversified and are positioned with a longer-term focus. And again, it bears repeating, no pun intended, even though they're not fun to live through, all bear markets share one commonality, and that they end. So stick with it. I know it's not fun right now. We will get through this. As always, feel free to call the office and we can talk about your portfolios, your financial plan, your insurance, your estate, wills, whatever the case may be. Or if you just want to call and talk about sports, the weather, whatever, we're here. We're always happy to share some ideas and talk with you guys. So hope this was informative and succinct enough and kept you interested. Enjoy your day and hope to hear from you soon. Take care.